Hi, this is Mike Maloney, and I've shown this graph before, but I've added one more data set here. What I've done here is we have base currency, the amount of paper dollars that exist or deposits at the Federal Reserve redeemable in paper dollars, and then the green line, which is the value of the Wilshire 5000 total market cap index. And then I've added to that the current tax receipts of the U.S. government. Now, on the Wilshire 5000, that's denominated in points, which is basically an abstract created from a mathematical formula. And there isn't as much tax receipts as there is base currency creation. So I've taken the Wilshire 5000 total market cap index times 47 to lift it up until it overlays the blue line. It is the green line, just to show you the difference in percentage. The difference in percentage move from this point here, where the blue line and the green line are on top of each other, to this point here, where they're still on top of each other, the percentage move for each of them is exactly the same. And what I'm interested in is the percentage move, not the number of points or the number of dollars. The tax receipts, it's the same thing. I've lifted that by 1.5 because it was down here underneath it and you couldn't see the correlation as well. I'm not interested in the number of dollars. I'm interested in the percent change. And what we see here is an incredible correlation, again, in tax receipts from this point right here back to about there. The tax receipts rise and fall with the value of the stock market until we started QE3. QE1 and 2 lifted tax receipts with the stock market. QE3 did not. Something changed. There's a divergence there. And I think what's going on here is, yes, the stock market is rising, except that's mostly the banks trading among themselves. So there's a lot of high-frequency trading. A lot of the public has actually been exiting stocks. And it's the public that really gets screwed when it comes to paying taxes. We pay more than the big entities do on a percentage basis. So the tax revenues that are coming in from this big stock market boom since the year 2012 roughly, those tax revenues aren't coming from the increase in the stock market anymore. So what you see is a divergence of the stock market going up where the real economy and the tax revenues that are derived from that economy, from more sales in stores and stuff like that, those tax revenues aren't increasing at the same rate that the stock market is going up. One of the things that I've shown before, though, the blue line again is base currency, and this whole economic recovery has been bought and paid for by the Federal Reserve with the bailouts in QE1 and then QE2 and then QE3. And then we tapered in 2014, and it's been falling since then, the base currency, how many paper dollars exist. But the stock market kept on going. Now, is that because we took the training wheels off and it's going along just fine on its own? I don't think so. When you examine this a little bit more closely, one of the things that you see is this tremendous correlation that I was talking about all the way back from late 2008. Base currency and the stock market traveled almost exactly together. And then there was this divergence that started to happen where the stock market kept on going after they stopped all of the currency creation. But what you see are these sudden crashes that take it right back down to the level of the base currency creation. And it's done that 3 times. And now the divergence is greater than ever. The divergence was pretty big the last time we talked about this, but now it's really big. And like I said, tax revenues haven't kept up. So the tax revenues really do represent the real economy, because this is how much blood the government is able to suck out of the real economy. And they're always able to suck a certain amount of economic energy out of the real economy. About 20 to 25% roughly is what they're able to take before they start collapsing the real economy. So that hasn't changed, the percentage that they take out. In other words, this growth, and if you look how this growth has gone flat now for the past several years, it's just been absolutely flat, the tax revenues. And then, getting back to the first graph, this current economic expansion, the white area here, is now about to overtake the white area here. There was one back in the 60s that was a little bit longer than this one. So right now, when we overtake this one, this becomes the third longest economic expansion in history. And then it has to overtake the one that's back here. It'll become the second. But this goes back to the beginning of the United States. We're in the third longest economic expansion in the last 200 and some years. That means that the chances of this going on much longer are extremely low. And now they're talking about a Fed rate hike. And so it'll be at exactly the wrong time. If they do a rate hike, that will probably be the trigger that causes the next recession, the next one of these gray bars. I think we're probably already in a recession, as you already know. A whole bunch of factors indicate that. And when they declare a recession, they're declaring that it started more than 6 months ago because it's a lagging indicator. So that's my take on that. But what I find scary, and I wrote about this in the update to my book, Guide to Investing in Gold and Silver, the 2015 update, that tax revenues now rise and fall with the stock market. And before that, the tax revenues weren't really dependent on the stock market. There was no huge correlation. But since the year 2000, there's a very high degree of correlation. So as we go into the next crash, tax revenues will fall, deficit spending will explode, the government will answer with more and more spending programs and so on to try and stimulate the economy, and it's a recipe for disaster. But it's an opportunity for some folks. You just have to find that opportunity. So I hope you got something from this video. If you did, please like it and share it and subscribe to our channel. Thank you very much.